Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. We're recording this interview on Tuesday, September 9th, 2025. The consumer price index, in general, in general, the narrative that's been repeated on business television and Trump administration press conferences by him and his press secretary and his cabinet is that inflation is coming down. It's not an issue. However, one of the big increases in the consumer price index is a huge spike in the electricity costs. I believe that's the biggest increase in the consumer price index. Today's special guest covers all those things. We've had him on before. He runs Conrad's utility forecaster and also which covers the energy electrical utility company stocks, which are dividend increasers. Also, actually, one of the most stable growth sectors. And he also co-authors the Energy and Income Advisor oil and natural gas portfolio with our friend Elliot Gu over there at Capitalist Times. Roger Conrad, thank you for joining me again.
Thanks, Jason. Good to be here.
So, Roger, I want to get your thoughts on that increase in the consumer price index. Like I said, are these electrical utility companies? Why do you think they're raising prices? Is there a huge increase in demand? Do they have inflation offset? Why do you think their electricity utility costs are going up so much? And can they actually pass the costs on to their customers?
Well, yeah, those are two very good questions, and they're very fundamental to utility investing, right? Because if utilities are seeing these higher costs and they're not able to pass along their those costs to the consumer, and they're not able to control them, then we're obviously going to be looking at compressed margins and lower earnings at some point in the future. Because and there's also the problem of how much what can the consumer bear? How much will the regulator allow the consumer to bear with rate increases and so on. So very important questions for this sector. Why are utility rates going up? Well, I mean, I think one thing that's really happened here that we haven't seen since I've been covering these investments, and that goes back to the mid 1980s, and that is a real kind of secular increase in demand for electricity. And that's coming from a lot of different areas. Back in the 50s and 60s, it was primarily the suburbanization of America. So, all these areas that had been rural and where no one was living, suddenly all these housing developments went up and, demand for electricity mushroomed. It's definitely, we've been going along and seeing more appliances and so forth using electricity. And that's been kind of steadily increasing demand for electricity along with GDP. Though not as much as GDP and not as much as inflation. But what's changed in the last, really, it's kind of an accelerating change. It started the last 2 or 3 years, but it's been really coming on, particularly this year. And you see that in individual company results. And that's just sheer demand for electricity. It's rising at pretty much the fastest pace that we have seen since that great suburbanization of America, which, long time ago, long before many of us were born, taking place. Now, what's driving this electricity demand? One thing is just simply that we're electrifying. We're using a lot more devices that are heavy power users. Everybody's got at least one computer in their home, more than likely. Everybody has a cell phone. I mean, all these things demand electricity where they weren't before. So that's one thing. The population is growing. That's another. What's kind of new, though, is one, a reshoring of manufacturing and large facilities that use a lot of electricity, industrial demand to the United States. Now, this didn't start with Donald Trump and tariffs and so forth, but it really kicked into gear with the pandemic and with the way that supply chains were suddenly disrupted and people started worrying, hey, are we going to have enough product if, say, China shuts in its factories as it did at one point? So I think sort of a wake-up call to the world that, we needed to diversify supply chains and, bringing many of them back to the United States. And in fact, China's become not so much a font of low-cost labor anymore. It's more being driven by technology, and these technologies are available to people building factories in the United States. Robotics being a very good example of that. And so the factories that are coming back here are not the factories of yesteryear that employed all these people, but they use a lot of electricity. So that's happening in a big way. We're seeing a big takeoff in energy exports in the United States. So that's another industry that uses a lot of electricity. The LNG, or liquefied natural gas, the proliferation of those export facilities, they're huge energy hogs. You have to basically supercool natural gas down to a form that you can put on a ship and send it somewhere else. So tremendous users of electricity, and again, that's been a big plus. And then really the icing on the cake, and the thing that I think we're probably going to talk a little bit more about here is artificial intelligence and data centers, huge energy hogs. But we are using artificial intelligence is here to stay, and we're kind of figuring out where it's going to be most useful, where people are going to want to employ it, what sort of applications are out there. It's obviously not good for everything, and there are all sorts of examples of where people have tried to kind of shove a round peg into a square hole to use it. But it is very useful in a lot of other areas, and what we're seeing in real time is demand. And so you have a company, say a company called Entergy is an example, and they serve an area of the country that's maybe not so much known for, rapid economic development in the past. Its headquarters is New Orleans, and of course, everybody remembers what happened with Hurricane Katrina, basically, wiping out a big part of that city. So not traditionally a really wealthy part of the country, at least in the last 100 years or so. But this company is seeing its industrial demand grow 12 to 13% a year. There's a lot of factories moving there, a lot of industry. Data centers are coming in there. They're not alone. It's happening all over the world. So
And that's near cheap natural gas, right? That's near the Haynesville Shale and some of the other ones.
right. That's it. So they're benefiting from the LNG exports. They're benefiting from a reshoring of manufacturing, particularly their Texas area, and then data centers, and that these have to be supplied with a lot of electricity, a lot of energy. So they're a big beneficiary of this demand. Now, the second half of the question is, can utilities, that because to meet new demand, you got to spend money, right? You got to have the generation. That's what everybody thinks about. But you've also got to have, the connections, the distribution, and the transmission, and so on. And the tolerance for outages. And this was a topic that was discussed as recently as back in the 90s. Really, is that with the proliferation of information technology, you really can afford far less outage time. And they used to call it the nines, right? How many 99.9999999. What's the acceptable amount of outages? And I'd say it's basically pretty much zero at this point. With artificial intelligence, so you have that reliability factor and that hardening of systems at a time when weather has become a lot more severe. Utilities used to have hundreds of millions of dollars of damages in the worst storms. Now it's in the billions and higher even. So
Yeah, I think Florida had trillion. I think Florida had like a trillion, or Texas had $1 trillion worth of damage in a storm in the last. It was an
yeah.
insane amount. Yeah.
Yeah, that look at that winter storm Uri, that took place in 2021. Just a tremendous sort of cascading outages. I mean, some people died, but also industry was shut, so the economy really took a huge hit. You really can't afford that those many outages, even no matter how bad weather events might be, even if they're from wildfires to hurricanes, whatever. So that's requiring a lot of spending too. So can utilities, get this money, through in, customer rates, earn a fair return on it? I think that is very much depends on where in the country they're operating. Now, there's some parts of the country that, power prices haven't gone up as much, and, these are primarily, this is another aspect of it. These are primarily the states that did not deregulate their power sector in the 1990s. In the 1990s, 15 states and the District of Columbia decided that competition in generation would be a very good thing and that it would drive down pricing. And so they basically stripped the generation function from the utilities there. The utilities in the Northeast today, for example, in New England, say a company like Eversource that serves Massachusetts and Connecticut, New Hampshire, and so on, they're only transmission and distribution companies. They're not producing, they're not generating any electricity. They're just taking electricity generated elsewhere and sending it to consumers over a basic charge. The states that did that, you would think perhaps competition would have driven down rates, but really what's happened has been kind of more erratic policy. And, my opinion after studying this industry for, I guess, about 40 years now is that what keeps rates low over time is the ability of companies to make investments, long-term investments, not think about, feeding the system over the next year, have a system in place where they can reasonably assume that they can make an investment for the next 10 years. And
Do you
the
mean
states.
now by investment it's vague. Do you mean like expanding the amount of electricity generation, or do you mean like upgrading like to fiber optic cables or better transmission wires? What do you mean exactly by investing and expanding?
Well, I mean, it pretty much all of the above. I mean, they've, because it all has to go kind of hand in hand. And now you also have, diversified energy sources, and some of which are intermittent, fairly pointed out as intermittent, such as solar power. It generates a lot of electricity more than ever, right? It's really cheap. It's easy to build these facilities, but you can build them in maybe a fifth the time of a natural gas plant. You can build an equivalent solar array, but it's only going to produce electricity for you in the daytime. You can match it with battery storage, and that can be deployed almost as fast. But it's still not that there are other nuances, right, in how you use this electricity, how you integrate it with the grid. So that costs money too. You have to do these upgrades on the grid. And there was a big power outage in Spain as well as southern France. And one of the reasons that seems likely that was caused is just the fact that, the infrastructure connecting that renewable energy to the traditional grid, which is used to doing, base load power that runs 24/7, except when it's down, like, a coal plant or a nuclear plant, it now has to run on, these different inputs as well. So that requires a big investment. The technology is definitely there at this point to make that happen, but you have to procure it and you've got to install it. So, and that means raising capital, and that means whoever you're raising the capital from has to have a reasonable, expectation of return. So if you have a regulatory system in place, and one of the first companies I saw that did this was actually in Hong Kong, a company called CLP Holdings, and they do 10-year investment plans there. It doesn't mean that they don't change those. There aren't things that happen and they go back and make alterations, but it does allow the company to do some really serious long-term planning. If they say, well, we're going to need to replace a nuclear plant, for example, that's a huge project that's probably going to take you 10 years to accomplish, given the kind of equipment you need, the expertise you need, and so on. And if you don't have a reasonable assurance that you can get a return on that, you're not going to get regulators to approve it, but you're not going to get the investment. But a company like CLP Holdings is able to do that. Now in the United States, we are seeing more companies being given that ability. In Florida, for example, a deal with the leading utility there, NextEra Energy, but that's a 4-year deal. So not as long, perhaps, as not 10 years, but certainly a lot of assurance that, for NextEra Energy, that these investments that the regulators pre-approved, it's going to earn it's going to return on. So
Well, those longer term plans, I would add here, Roger, here in the United States, is the big technology companies. So your Microsofts, your Metas, your Googles, those are the Amazons. Those are the ones who are stepping up and saying, we want to make sure that we have reliable baseload electricity generation locked in, not just for 5 years out. We want 10, 15, 20 years. We want to make sure that we have reliable electricity because we're going to start building out the infrastructure. Now, you mentioned data centers. The listeners out there are not familiar. We have the existing data centers, which are good for like YouTube and Netflix. So streaming, basic internet connection, your smartphones, Wi-Fi, using internet on those types of things. But for the next generation data centers, I mean, we're talking Elon Musk already built in Tennessee there for XAI, the Colossus data center. That was 100,000 NVIDIA Blackwell GPUs. He scaled that up over, I think, under 6 months. He built the first facility in record time for 100,000 GPUs up to 200,000. Roger, he's talking about like a million GPUs like in the next couple of years. And then he's talking about even more than that. And I think Meta just made, you mentioned deregulation. I was going to bring up Enron, but I didn't want to interrupt you. Like Meta is making like Enron type deals. Have you seen the press releases? Meta wants to guarantee like financial backing all construction cost overruns for the data centers now.
yeah, I think that's you know gonna. I mean, the more of that kind of thing happens, the more of these things actually do get built. I mean, you mentioned Elon Musk's data center, and that's in a really interesting place. The land is fairly cheap around there. It's an old industrial park, actually, in my hometown of Memphis. It's in an area that pretty much nobody will ever set foot in. There's a Valero refinery there, pretty nearby, within about a mile of it. And yeah, it's a huge energy challenge, and I think it's a good segue into how's this energy going to be going to where's it going to come from? As far as I mean, just to cap off what you said about the utilities, I think from an investor point of view and the way I'm looking at it, some areas of the country are giving more assurance of there's more assurance of that investment will be earned a return on. And in those states, that's where I think most of this action is taking place. And I think, ironically, I think there'll be the least effect on other ratepayers. In states like Texas, I think are pretty attractive for that. Florida being another one, but it's really a state by state thing. And again, when it does tend to work if companies are allowed a return on their investment, they'll build more, and then of course supply and demand kicks in, right? Because the more upgrades are made to grids, the more generation is in place, the more supply, the more the price comes down. So ultimately, I think that's if we encourage investment, that's what will happen. Where it won't happen is if when things happen where the government may discourage investment, or the economic environment discourages investment, or state regulators discourage it. Those are trouble spots. And if you do get, I do think that companies like Meta and so forth, they are smart enough to see that trouble coming, and I think that's why you see most of these places, most of these things located in actually favorable in regulatory environments that are favorable for utility investment, and other parts of the country being left out. But okay, let's get on with the other part of this, right?
Well, I was going to bring up how those data centers that are being planned or under construction, a lot of them aren't even online yet. Like the Stargate one, I think like is not even online yet. That's the one out in the middle of nowhere in Texas, but it's near all the natural gas fields. So it looks like the majority of these data centers now, not here in Northern Virginia, because we're the data center capital of the world right now in the DC metro area in Northern Virginia, but the other data centers that are under construction, looks like the tech companies are all trying to build them out in the middle of nowhere in the Midwest. Maybe it's cooler out there. They're trying to make sure that it's near a nuclear power plant or near like an existing low cost natural gas supply. So then maybe they just have to build a pipeline in a separate subsector electrical substation or separate power station there just for the data center.
Yeah, absolutely. I mean, gas is huge. I mean, a lot of what is the most what is basically powering our electric system today? It's natural gas. I mean, at 40 and close 40 45%, even higher in some areas of the country, and that is also a big variable for electricity prices, right? If yeah, because it's such an important part of generation, if the price of gas goes up, then the cost of that electricity powering that data center is going to go up. So I think that's a real challenge for, I think, a lot of these data centers going forward. Where do they, and these big tech companies, I mean, how much are they willing to, leave in play in terms of fuel cost? How much, margin compression will take place if, say, the price of natural gas goes from around $3 where it is now, $3 per million BTU. Say it goes to $5. What does that do to their margins? And traditionally, it's been a huge uh, drag on the data centers you were talking about before. These are the traditional data centers, not the ones that now have these sophisticated um, you know uh,
100,000 or
GPUs.
more, yeah, GPUs, yes, and then
Yeah,
like insane cooling systems. And I mean, they're talking like
yeah.
Roger, they're talking about way more than 200,000 GPUs per data center. I mean, I've heard clusters people talk about theoretically with the new designs getting up to a million or more GPUs at a data center campus. Is like it's nuts.
Yeah, well, so one avenue, and we've seen this happen, and there's three of them that were closed in the last 10 years and are coming back are older nuclear power plants, that have been shut, that were taken offline. You know, Nuclear hasn't been competitive with gas for quite some time, and back from, I guess, 2011 certainly didn't help anybody that was thinking about building a new nuclear plant. In fact, finally, at the end of the day, just two reactors are built, the Southern Company ones in Georgia. But
You're
what
talking
also
about
was,
Fukushima. For our listeners out there, Roger, 2011, he's talking about the Fukushima Daiichi plant. So that was a bear market that because uranium wasn't a bull market prior to the Fukushima disaster, and then uranium and nuclear power went into a bear market for like 8 or 9 years. But it looks like we're finally having what a nuclear renaissance now, as these tech companies and China are basically scrambling to either expand existing nuclear power plants or restart the older ones, like Roger was saying, what they're restarting the old 3 Mile Island. I think they rebranded something else, but pretty much all the tech companies, whether it's Microsoft, Amazon, Meta, Google, they're all trying to negotiate with existing nuclear power plants because there's permits in place, I think, to expand the existing ones.
yeah. So there's three of them now that appear to be, in good shape to restart. And there's one in Michigan, the Palisades. There's one in Pennsylvania that's already pretty much locked up by a big tech company. The output, and now there's Next Era Energy is restarting a plant in Iowa. So that which they're also trying to get that contracted. Depending on what you read, uh, the remaining plants that were shut down in the last 10 years, for economic reasons, they just couldn't compete with gas. Those are it's sort of up in the air which ones of those could be restarted. But there's a big effort going on there, and there's at least a dozen plants that I count that would fall into that category. Plants that were supposed to keep running for a much longer period of time, and instead were shut because just building and operating a natural gas plant was so much cheaper. I should explain. I guess I should say what is so great about nuclear power. Why are all these why do they want to reopen these old plants, or and so if gas is so much less expensive. And the reason is simply that they run all the time, first off, except for outages. But we have learned how the operators of nuclear plants have learned in the last 20 years, with a dramatic improvement in operating rates. So these nuclear plants used to run 60 65% of their nameplate capacity, and now they run routinely 90 95, even higher. So that's a huge difference. And one reason they've been able to do that is because there's been consolidation of ownership. So lessons at one plant, if one plant a company operates is having a problem and the problem's identified, it can then, at the next refueling outage, fix that problem before it becomes a reason to shut the plant down, off schedule. And so that type of thing has been dramatically cut down. The operating rates are great. So as a result, it's very reliable energy. And then, number three, it's not, uranium or whatever your basic fuel is. The cost cycle is much less volatile than oil and gas. So, you can pretty much get a contract with a company, reopen the plant, and then, you're golden. You can pretty much count on that cost. You can also count on the federal government to subsidize. The Duke Energy, for example, collected about or took tax credits of about $550 million last year just for operating its nuclear plants. Now it has a lot of nuclear plants, but those are very generous tax credits, and they're available for any company that's reopening a plant as well as companies that continue to operate. So a lot of economic advantages. You can really
Is
lock
Duke
things in.
is Duke the largest operator of nuclear power plants in the U.S., or is it like Constellation or Dominion?
Constellation is, yeah, large. Constellation has, I think, 23 operating plants, which is about twice as many as Duke. So they haven't broken down lately what exactly their savings rate is, but it's considerably more. And then there's also what are called zero emission credits in many states, particularly in the Northeast, states like New York, New Jersey, Illinois, and these are state tax credits. So, the nuclear industry is being very much helped out right now. So I think that's one reason it's very attractive. I mean, I think the real problem that tech companies have, and is there's no real commercial design for either that's the least bit economic relative to gas, whether it's a large scale reactor or an SMR, a small scale reactor. Certainly, a lot of money going into trying to develop one, and I do think that somebody's going to, and I
Well,
think
we're
there
we're
will
at the
eventually
pilot
be
plant.
one.
We're at the pilot plant stage, right? So they're small.
Yeah,
I think they're going to start bringing online what small pilot plants in Texas for small modular reactors. I think I saw Wyoming or Montana, somewhere in the Dakotas and Midwest. So there's a handful in the United States and a good amount in Europe. And I think in England and the United Kingdom. So they're bringing online these next generation nuclear ones, these smaller modular reactors, but it's not at a full scale, like you said, to where it can handle the electricity for a giant data center like Elon Musk size, the Colossus one, or can run the
yeah,
power for all the city. It's just we're at the pilot plant stage right now.
yeah, absolutely. And if you listen to the industry people, they're going to tell you that, yeah, this is something that we're really interested in, and we're going to commit resources to, but we're really not expecting new nuclear to really have a significant impact on our power stack until possibly the middle of the next decade, possibly even longer. I mean, and nuclear power is widely considered to be probably the riskiest investment you can make as a power producer because just for one reason mainly, it's that these projects take a long time. Even if you did streamline the regulatory process, and the administration's trying to do that now.
Well,
There's still.
China can build a nuclear power plant what in under 5 years or less, but the United States it takes way longer.
Yeah, it takes longer. I mean, and I'm kind of two minds on this. I mean, I obviously there are things that you can do to cut through red tape and that isn't doing anybody any good. But you can't really argue with the fact that the U.S. nuclear system in the last 30 years, has really an impeccable record for safety. They have focused. The NRC is really focused on issues that can go wrong and endanger and so on. And I think you have to credit that at least partly for uh, the fact that there is no incentive really to cheat. There's every incentive to learn what you're doing and run these plants at faster rates. But If there is a 3 Mile Island or some sort of accident, there's a widespread recognition that that could really shut everything down even more. And I mean, we forget that just a decade ago, you had a lot of people that were trying to shut down. Uh, well, really, 5 years ago, even. I mean, when Indian Point that was shut in New York, that was shut just earlier this decade because and as a result of a long opposition campaign that finally definitely resonated with the public, and so as a result, they shut down this plant that was, I don't know, 25% of New York's power, and it was replaced by fossil fuel power.
And
In a state
Europe
that
was even worse. I mean, like
yeah
before the pandemic, I think like Germany and other European Union countries, the
yeah
United Kingdom, I mean, they were talking about shutting down all of their nuclear power plants, but then they had oil and natural gas drilling bans in a lot of the European Union. Their energy policies just didn't make sense. They overinvested into wind and solar, inefficient. You brought up an important point though here in the United States. It's just ridiculous. It's extremely inefficient and very costly to build a new nuclear power plant from scratch. I think what it costs like another $8 billion, and it took like 7 to 10 more years to build that Georgia power plant. It was way over
yeah
budget for the construction time. So if you're an investor, you're a utility company or you're a big tech company
right
making the investment with the utility company, I mean, like if you're going to wait another 7 years and it's going to cost you another $8 billion for your
yeah.
nuclear power, I mean, you're not going to stand for that.
Well, yeah, I mean that is what happened to the volatile reactors in Georgia and why they were so far over budget. And it didn't hurt the company because they had a deal in place with the regulator. It didn't, but even Southern's a huge company, right? But it still had the tremendous cost overruns that it had to eat. So you talk to the CEO there, and he's going to say, well, we love this plant. It's great. It's a great machine, and it's going to produce a lot of low cost power without emissions. And but are we going to build another one for not anytime soon? Another point here is that why is it so expensive to build here in the United States? I mean, it's sure regulation is more regulation is part of it, but it's also kind of a chicken and egg thing because we just don't have the supply chains in place. Even we don't even have the supply chains in place for natural gas turbines, which is why you hear companies talking about 5 to 7 year window for ordering a new major, baseload natural gas plant because you just don't have the production lines in place as you do in China. So China has building nuclear plants a very developed supply chain from engineers, labor, materials, all these various things that we don't have here because we've only built 2 reactors in the last 40 years. So, that is also something that's that's going to have to change before we can really see a whole lot of new, demand met by these nuclear plants. It's why reopening these nuclear plants is such an intriguing idea and why so many companies are really trying to push the owners of these plants to do that. Because that's just a lot. You can do that. You have the site, you have the connections, the transmission going in. You may have workers around that you can pull back as well. So
But also the
that's
biggest bottleneck, so the average person, Roger, we were talking about this before we start recording. You pull out on your phone ChatGPT. What you don't understand is that on the back end, the servers is using way more electricity. The tech companies are figuring this out the hard way that they have to have the infrastructure in place with the data centers, the reliable electricity before they can continue to build the data centers. So a lot of these data
yeah
centers that we're talking about for the future, the next generation ones, most of them aren't even finished yet. Some of them haven't even started construction. What these tech companies are looking to do first, Roger, is they're trying to put it in a location to where they get reliable electricity supply first.
absolutely. I mean that's got to be your number one priority if you're
Or you've built
located.
a white elephant, yeah. Or you've built a white elephant. You built a
Yeah.
data center in the middle of nowhere, and you don't have the infrastructure and the electricity to bring the data center online.
Yeah, well, so like we talked about Elon Musk and that and his mega center. That's an area of the country where you can build infrastructure. There's available energy. So he may not want to run that facility on natural gas forever, but at least it's something that he can do, and prices are still fairly low. And gas is, in Texas, the Permian Basin, up until recently, they've been basically flaring gas to get the oil out. The gas associated gas that occurs with the oil. That's a lot of gas that now you see companies building, gathering infrastructure, processing infrastructure, pipelines, storage facilities, and so forth. That's a lot of gas that can be tapped. But it's one reason why
Well,
Texas is so attractive.
you could send that natural gas via pipeline. You could send that down to a liquefied natural gas export facility with Cheniere, one of the other ones in Texas or Louisiana, or you could put it to the data center, to the Colossus, not Colossus, the Stargate one that OpenAI and Oracle and some of the other tech companies are building in Texas. So there's going to be more options to divert the gas into somewhere it's actually needed instead of flaring off, like Roger said. So it'll be used efficiently then.
Yeah, absolutely. I think, and that's again what companies have to take into consideration. But it's a huge opportunity for anybody up and down the natural gas value chain. And that I don't think, obviously not every state is pro natural gas, and there's some places where you're just not going to be able to build a pipeline. I don't, no matter how much the federal government may
Yeah,
want to
Northeast,
push for
man,
it. But
New
places
York
like
and
Texas don't have that.
Massachusetts. Yeah, most of California and most of the Northeast. Yeah.
Yeah, I mean, and places like Texas don't have that problem. So, I mean, they are going to get the business, and they're going to build their infrastructure, and by and large, I don't think there'll be that much. I think the net economic benefit, at least even if you don't factor that in, I don't think there's going to be a tremendous impact on the consumer, because again, they're going to be able to do that at least in the near term without really creating a massive bill shock, or rate shock for consumers. Other places, not so much, right? I mean, uh, and it's going to be more difficult to get that stuff through. And that's, as an investor, I mean, that's something I really watch closely. What's going on in these rate cases? How much are they asking for, and how much are they getting? Um, back.
So far then, Roger, sorry to interrupt you. So far, if I could summarize, you would say then that the utility companies that you covered, none of them have had any difficulty passing along price increases. So that CPI number, the utility companies are saying our costs are going up. We have to pass on costs to the businesses and the consumers. There's no huge problems across the board industry wide yet with margin compression or input costs.
Well, no, not so far, right? But I mean, there are signs of trouble in some places that I think are important to keep an eye on, in terms of, and when I say signs of trouble, it's basically, yeah, how much if they're pushing through, you know, really big, trying to push through really big rate increases, whether they're successful or not, odds are they're going to take a big haircut on that. And they're not going to get
Well,
everything they want. In other words,
are you
I,
saying that like is it like small business and regular consumers like families that are fighting back? Because I mean, if you're Google or Microsoft paying a little bit more for a secure supply, I don't really see it as a big issue. Now, I think like
right.
we could see some cutback in capital expenditure for some of these tech companies on some of the budgets for data centers, but they seem like really, really committed to it. I know a lot of
I
people have
think
been
so.
saying I know a lot of people have been saying that like, oh, their capex budget is about to be slashed. I mean, I've heard that for over 12
Yeah.
months. That like they're
Yes.
calling it top. That like Meta's done, Google's done. They're going to cut all their budget for spending on capex for data centers and stuff like that. But I thought they already spent a lot of it, and those data centers are just waiting online to start construction.
Yeah, I think that's right. I mean, we've been hearing people, kind of saying, well, it's a big bust. No one has demand for these applications, and so on. They're not going to spend. They're not going to make the order. But everything, it's 180 degrees from that on the ground. I mean, you even see new a lot of companies talking, really
It,
increasing their, all around the country, they're increasing the
it
backlog.
I had a
Uh,
friend who's a computer programmer in tech, and he was comparing this to the 90s build out with like fiber optics and those data centers. Those were smaller scale, but he's basically saying, because I see all the the charts up saying that like only about $18 billion a year in profits from artificial intelligence so far. Well, they're building out the infrastructure first. So they're figuring out how
right.
to use it. They're upgrading the software. The costs are coming down. There other businesses and other industries are applying the software. It's very similar to that. Well, at first, right, with all the websites and the eyeballs, there was the tech bubble crash, right? And then after the tech bubble crash and all those tech stocks crashed, then out of it came what profitable Amazon, profitable Google, profitable
Oh
Meta.
yeah. The best of the biggest, came to dominate in the industry. They changed the world forever, but I mean, you did go through a tough period, I guess, in the stock market. One more point I just wanted to make about the utilities, though. I mean, because we're talking about, is there like a trouble spot coming? And that is that, um, they basically are building to demand these days. Back in the 70s and 60s and 70s, when they were, when all the giant coal plants and nuclear plants were built, companies would basically build and then ask for, regulators to approve what they'd spent. Nowadays, the companies, submit their plans, and they don't turn a spade full of earth until it's signed off on. So they're taking far less financial risk now than they were back in that day. Now there are examples where that may not be the case. I mean, at some point, but that is what we're seeing. I mean, and for better or for worse.
Especially if the tech companies are
Yeah,
saying, "Look, we're starting construction right away on this data center.
yeah,
Here's like a couple $1 billion to go upgrade your power station, or we want a new power station, a substation built right next to our data center, like Stargate AI." So, I mean, if the tech companies are going to do that, it looks like smart partnerships. Things are being done more efficiently for the infrastructure, which hasn't been done in the U.S. in a long time.
yeah. I think that's a hopeful way of looking at it. I do think that is how things will evolve, and there will be some trouble spots. There will be some states that where white elephants, as you say, will be built and probably never used. But I think for the most part, it's from what I see, and just utility capital spending. Pretty much it's all companies. The EEI, the Edison Electric Institute, which is the primary trade group, puts together information and projections on what utility capex is going to be, capital spending, and they're routinely and it's just based on what utilities tell them. They're you know just chronically underestimating what is actually spent, and you see almost every time guidance is updated by these companies, another increase in what they expect to spend. So,
Well,
I mean, it's
I
happening.
have the capex for the tech companies, Roger, the sixth largest one. It's around $300 billion that was projected for 2025, and that's not counting Europe. It's not
Yeah,
counting China. It's not counting those tech companies that are building data centers and building out the artificial intelligence infrastructure. So they're going to need reliable baseload electricity generation and pipelines and nuclear power plants and stuff too. So I mean, it's absolutely massive going forward. Do you expect then, would it be fair to say that the electrical utilities then have some of the most stable long-term growth you see of any industry right now?
yeah, I think so. I think it could be faster, particularly if interest rates should come back down again. I mean, if the Fed starts uh, uh, reducing rates, and it's not taken as kowtowing, say, or bowing to political pressure. If it's seen as prudent move to reduce the cost of capital at a time when the labor market's softening, even though there's more inflation out there than they'd like. If it's seen that way, then I think borrowing costs come down for these companies, and they could potentially grow even faster. Right now, that is a big a question mark. What's going on? What's happening with borrowing costs, and they have come down a little bit, but the more borrowing costs go up, That's also another driver of customer rates, because that's cost of capital is one of the things that it's not a perfect relationship, but it does factor into rates in terms of return on equity that companies are allowed. If borrowing costs go up, the return on equity is going to go up, simply because the utilities won't be able to raise capital or otherwise. So
Are these
um,
utility companies, are they like refinancing a lot of debt often, or are they issuing like longer term duration corporate debt, say like 10-year, 20-year, 30-year bonds, and then if interest rates come down, do they refinance? How do these companies usually capitalize themselves and finance themselves?
Well, back in the early part of this decade, interest rates were very low. So you saw a lot of refinancing activity. And I think that's definitely helped them, uh, and not have to issue a whole lot of debt the last several years. But you have also seen, increases in interest expense pretty much across the board with every company. These have kind of moderated the last year and a half or so, because the well, the Fed funds rates come down, interest rates themselves have kind of moderated a little bit, so that's been a plus. And you do see bursts of financing activity, refinancing mainly. But of course, these companies have to borrow in order to build, right? The capitalization is going to be partly equity financed, partly debt financed on a typical basis. So um, that's they're
Well, unless like Meta comes in and is guaranteeing everything like Enron, I mean that's kind of the new addition here to the
yeah,
picture. Because what you mentioned was the past, but if Meta is going to come in and they're going to take all their free cash flow, their profits, or a lot of it, large chunk of it from Instagram, and they're going to subsidize the build out of this data center, and they're going to give the utility company because they want a new nuclear power plant or an expansion of a natural gas one, they're going to give them a subsidized loan at a low cost, or maybe just throw in some cash, no debt,
yeah.
then it's a different financing picture.
Well, yeah. I mean, it's all about having the money, having the capital, and where it's going to come from, and it's all for the utilities. It's and other power producers, like Constellation, for example. It's what's in the contract. So right now, and that's another good point. I mean, right now, what you hear from the power producers is that they're able to pass through additional costs into contracts, and they've been able to pass through additional cost of from higher interest rates, from various inflationary factors like labor cost and so forth, the impact of tariffs, as well, on things like imported steel, or even components, gas turbines, or solar components that are imported from other countries. Right now they're pretty confident. If you listen in on the guidance calls, they're pretty confident that they can push through these costs, even the loss of tax credits, which is going to happen in for wind and solar at the end of 2027. They're extended for energy storage, they're extended for nuclear energy, and for geothermal. But for these areas where all this money's been going in to increase output, in large part because they can just build it so much faster. Um, but costs have come down, efficiency has gone up. But they're saying, well, we can even build these things and absorb the loss of the tax credits and keep our margins high. So it's a very high demand environment, and demand growth environment, and it's a it with the data, the big tech companies have the cash, like you said. They definitely have the motivation, because they want to win this AI race. They want their products, they want their processes to be dominant. So they're willing to spend all this money they're making, and their stock prices are historically valued now. So even equity finance is an easy thing for these companies. Uh, it's I think you definitely have all the elements there to keep this going for a while. I mean, there are obviously things that can happen to kind of throw things off the rails, but one would be perhaps a crash in the stock market, a real big dislocation in the capital markets in general. Um, and that would make things more difficult. But uh, you
So
know,
since we're going a little off tangent here and covering the tech
yeah,
companies, and I want to go back to your focus here, since you're an electrical newsletter writer for many years for electrical utility companies, I know you've covered these companies for many years. Are we at towards kind of the high end of the range here for profit margins for these electrical utility companies, free cash flow margins, growth potential? Are we like in a real sweet spot for the companies that you cover?
I think, if you look at, because all these companies now are talking about, we're going to grow our earnings and dividends, 5 to 7% a year, 6 to 8% a year, some 7 to 9% a year. I think those are generally conservatively set. But the stocks really aren't priced for that kind of growth. So yeah, I would say, they're probably undervalued for what the opportunity that they have. That has another good benefit as well, and that is that if for some reason things aren't as rosy and they don't grow as fast, um, unlike the tech companies, those valuations aren't baked in, and that same is true for gas pipelines and gas producers. They, again, by not reflecting the full potential of this opportunity, they're not as vulnerable if it doesn't all materialize the way everybody hopes it will.
Yeah, because I'm looking at the natural gas price here. Natural gas price is in a huge correction mode. What the last 6 to 8 months, it went down to $2.30, $2.40 at one
Yeah,
point. You would think that the lower natural gas price would translate to better profit margins for some of these electrical utility companies, but then we saw the consumer price index spike with electricity. So you were saying that a lot of it's because of the demand increases for reshoring with the manufacturing, but also a lot of it's because of
yeah,
the data center build out. Then the next generation ones.
yeah, and those gas price decrease actually, that will show up probably a little bit further down the road. So that would be a positive. The lower prices that we've seen in gas from April through really just up until the last few trading days when gas went back over $3. But that's all gonna, yeah, I mean, that will benefit. That is actually, though, the fuel costs are a direct pass through. So that would benefit the utilities in terms of rate headroom, investment headroom, in that the actual cost of the consumer will come down as there are fewer gas fuel cost pass-throughs. It will not directly affect the utility profit margin, but again, it means they can probably invest more, and that component of the customer rate can go up more if the price of gas is coming down. This was a real virtuous cycle. It's been a real virtuous cycle for long periods in the last decade or so, where you've seen utilities able to actually cut their rates even as they were investing more, and that was a lot on the back of low gas prices. To some extent, we're still filtering through what happened with Winter Storm Uri in 2021. When gas prices really spiked. I mean, you went from $2 or $3 to like 10, 12, and utilities really could not pass that through to the consumer all at once. So what happened in a lot of states, for gas utilities, but electric utilities too, is you saw these costs being what are securitized. So basically, they took the cost, they turned it into a bond, and issued the bond, and the bond to be paid off by ratepayers as a surcharge over time. So
Is that like a municipal bond then or something like that?
yeah, they're low cost. It's low cost debt, right? And it is tax. In this case, tax advantaged, and so that's an advantage in terms of what the interest rate is and what the consumer has to pay. But yeah, the idea being that, yeah, the utilities are made whole because they get the cash from the bond issue that pays for the fuel costs, and the consumer doesn't bear the full burden all at once. So this is actually you're seeing legislation in many states to make this a regular thing. Which would cover spikes in commodity prices or fuel costs. It would cover other one-time event such as the impact of a really devastating hurricane or wildfire. And that's yeah, it's a that you I think you're going to see more and more of that um, going forward. They don't. They also tend to have. They don't tend to get to provoke a whole lot of customer opposition because again, it's no one wants that utility to eat all the storm cost and they're therefore be unable to make other investment, but nobody wants to pay a full on you know high rate either. So
But no
this
one wants their power out either. So everyone's
right.
connected. That's one thing you brought up at the beginning of the interview is
Yeah.
how electrified everything in it is. I mean, everyone in their house now has they have streaming, they have internet access, they have tablets, they have
Yeah.
smartphones. So I mean, like everyone's on Netflix or one of the other streaming platforms, or they're using internet on their smart TV.
All hell breaks loose when the power goes out, right? I mean, we just we don't expect it. And many of us, even if you're going to an office, you're probably going to be taking some of your work home. And you you can't, you have to be prepared. Yeah, it's not a great thing. So yeah, I'd say
Especially how young adults all want to be streamers on YouTube or other live
right.
stream platforms now. Yeah, it's just getting absolutely ridiculous. So as we wrap up here, Roger, one more question since I get asked this: data center capital of the world in the United States too. Data center capital of the United States, data center capital of the world, Northern Virginia right now by far the most data centers
By
concentrated
far.
here. Yes, in not only the United States, in the entire world. Here for military, for the U.S. federal government, for the tech companies that are moving out here. Want to ask you about Dominion Energy.
Right.
Do they have the most growth? Do you think their stock is the most overvalued? Because if I was like a generalist institutional investor managing money, I mean I would probably just buy stock of Dominion to get exposure to this data center play. Is that what most of the regular generalist investors are doing?
I don't think so at this point. I think actually Dominion is probably fairly cheaply valued, and that sort of just is part of what's happened to this company. So um, they owned a lot of natural gas infrastructure in the previous decade. They have exited that. They wound up, but by virtue of being pretty acquisitive, they took on a lot of debt. So that was one problem. They also when a state changes, one of the things I really look at around election time is when does a state change, political parties, political control? Because particularly today, energy is so politicized and everybody's got their own opinion, and governments are trying to do, they tend to interfere more with the private sector than they have in the past. So in the state of Virginia, we had a Republican governor, we had a Democratic governor in the previous decade that was very pro, renewable energy spending. So what is, Dominion's comes up, has a plan, it's approved. They're investing pretty heavily in a lot of things. The main project being, coastal Virginia offshore wind facility, and that's the biggest offshore wind facility in the world. When it's completed, it's 2.6 gigawatts. So, they're building big because they have a lot of data center demand. That's a huge reason for them, particularly in Northern Virginia. So that became a big piece of it. But when Governor Youngkin was elected in 2021, there was a completely different sort of focus. So they kind of went through that. Bottom line is they have had a kind of a restructuring, not really restructuring, but kind of a strategic plan that's required them to be more conservative. It's required them to really execute on the capital spending, the heavy capital spending they've been doing. And it's required them to stay very connected with the regulators because then, 2 years later, there was another swing in the Virginia legislature. And now we have an election coming up. So this year for governor. So they really had to kind of, because of their heavy capital needs, they've had to really do a lot of work to stay on, on the right page, I guess, with the government and the state. So that's all weighed on their valuation. So I do think that they have tremendous potential from here because precisely because of that big capital plan and because of all the data center. But it does kind of demonstrate the other side of the equation for a utility, right? It's spending and investment plus regulatory support equals, strong earnings and dividend and ultimately dividend growth down the road. But if you take out one part of that equation, you're not going to have that robust uh, earnings and dividend growth. And I think that is still a concern for investors. Not as much of one as a couple of years ago, but certainly something people are watching very carefully when they look at Dominion Energy as a stock and as an investment. Again, I think once they get this facility built, they're also building a lot of gas. Once we get this next election behind, so we see like who they have to kind of placate, or whose policies do they have to kind of move along with. Once all that's behind them, I do think we're going to see that stock at a much higher price. I think we'll see a lot more interest in it. But yeah, it's kind of ironic that here you have the company that is the biggest beneficiary of this boom. There's so much more ahead for it. I think something like 40 data center contracts that are in various processes of of being of completion.
Yeah, I'm not
And
sure. I'm not sure the construction
crazy.
timelines on some of them, but like we were
Yeah,
discussing this over the last like 6 to 12 months. I mean, the land deals. I don't know if you've seen some of them, like Amazon and Microsoft. I mean, they're paying over
yeah,
$100 million to buy packages of forest land, 30, 60, 90 minutes right outside of Washington, D.C. in Northern Virginia and D.C. metro area. They're paying way over $100 million, and Amazon's talking about building entire campuses of data center.
yeah.
Microsoft is talking about it. Mark Zuckerberg just bought a mansion here in the D.C. metro area.
Yeah. Yeah. I mean, this is where you want to locate. I mean, obviously, it's the critical mass of the sector. You can build in other parts of the country, and there's a company I follow, MDU Resources, that's in the Dakotas and so on, and they're just one data center out there that's now in operation. There's another one under construction. They're going to be taking about 10% of their demand within the next 5 years. So that's a phenomenal growth story for this company, but it's very small, and we're talking about a huge big deal. It's like it's sort of like that. It's just a lot of leverage. But for Dominion, really, this is it's at the epicenter, and state of Virginia. Even though there has been back and forth in terms of political control, it is a very business friendly state, and I think that Dominion does. I think will come out on the right side of it, but it is I think a stock where it's just this is gonna happen over the next year or so rather than right away.
Do they have the
Because
most upside then with growth potential over the next 5 or 10 years? But it sounds like there's a lot of potential what ifs then. So like
there
how
is,
quickly, yeah.
or
So
yeah,
so like there's the large tech companies are spending buying all these land packages out here. I know Meta's spending money all over the United States, but like a lot of the investment is just concentrated in this area by the tech companies. So you're saying that Dominion potentially long term they have the most growth from the data center build out?
yeah, I think so. And another point that just occurred to me from what you said. I mean, with these big companies moving in, that's a powerful constituency for supporting Dominion's investment in the state. So that's pretty huge too. I mean, these governments don't operate in a vacuum, and
Well, yeah, look
uh,
at the tax breaks that Amazon got in their new headquarters in Crystal City.
yeah, yeah, absolutely. So there, yeah, I do think it is a stock I own. It is a stock I recommend. Uh, but like you said, the reason that the reason that it's not fully pricing in all this really great news, as other stocks are, Constellation, for example, or being a good example. I mean, the reason is there are a lot of what ifs, and I can sit here and tell you that what I think is going to happen and what should happen, but when things graduate to the political realm, uh, you know, it doesn't always work out that way. So,
Well,
uh,
there's a huge amount of backlash by protesters here. I mean, because like they put some of the data centers that were either recently built, smaller ones, or ones that are existing. I mean, they're near residential areas now, so that's really destroying property values. So now there's a ton of protests over that too.
yeah, I wasn't. Yeah, I guess it does. Locating an industrial facility near residential properties. I think, eventually, I don't. I mean, I guess you could. I think you could also make the case that long term it actually enhances property value because just on the basis of the fact that you're not likely to have power outages, or you're less likely. But
That's
um,
only part of it. I mean, like
yeah,
there's emissions there. There's the noise. I
yeah,
mean, some of the people around the data centers. I mean, I was reading some of the counter arguments here with some of the local Fairfax County paper articles. I mean, they were talking about the noise
yeah,
for the residents living around there, that it's like destroying their property value. They can't sleep. I know, like
not good.
I think Google tried to buy
Yeah.
like an entire neighborhood out in Loudoun County, or it was Ashburn or Loudoun County, and
Wow.
they offered, there was townhouses there that were worth maybe like 1.1 million, and they said if everyone in all these streets agreed to a buyout price of $4 million, that they would just buy all the townhouses and demolish them because they wanted all the land
Wow.
to build a data center campus. But they couldn't get every single person to sign off on the deal to agree to sell their townhouses for 4 million, so the deal didn't go through.
Well, yeah. I mean, that's politics, I suppose. I mean, that seems kind of crazy. But yes, just spending that
Well,
kind of money. I mean,
homeowners.
it's a very good example of just how much money we're talking about here. It's a
Oh yeah,
huge,
nine-figure
huge
land
deal.
grab. The average listener doesn't understand this. They track these land deals on local Northern Virginia business journals, but also like data center dynamics and some of the other data center websites. And a lot of those data center websites are headquartered here. So like the tech
Mhm.
companies are just buying up land like an insane amount. And now they're
Yeah.
building smaller data centers in the Midwest. So they're building ones here and there, but the majority of the campus sized ones they want to put near natural gas or in Northern Virginia.
Yeah, absolutely. I think that's, you have, and again, you have the most profitable companies, arguably in the history of the world, willing to spend more money than anyone's ever spent to make this happen. And, the government, the federal government's behind it, states are behind it. I think, they're, like you say, I mean, not everybody's behind it, but not everybody supports it, but it's, um,
The majority, the current administrations, a lot of them are behind it under certain conditions, maybe, but we'll see. I mean, things can
yeah.
change depending upon how the elections go, or maybe they force the data centers to only have wind and solar, but then they might not be as reliable. I think wind and solar are good to complement the other natural gas or nuclear power at the data center.
Yeah, they're cheap to build, but there are limitations, right? I mean, the arguments that you can just go 100% wind or solar that you see, that was sort of the original energy politics, I guess. But I mean, you talk to anybody that that's we're not there at this
Well,
point
yeah, talk to
anyway.
Elon Musk. Elon Musk is huge
Yeah,
on solar power. What he has Solar City, that company, but he's huge on
yeah,
solar power, and even he said that it's not ready to supply like the data centers he wants to build.
yeah.
So,
It's quick. It's quick to build. It's way more efficient and cheaper than it was 10 years ago. But right, there are limitations. I mean,
well,
even if you
it
pair it
can't handle
with
a two
storage.
hundred thousand chip GPU NVIDIA Blackwell one that needs to be super cooled, right? Because the amount of like heat and electricity it's using for the cooling system and the electricity is absolutely insane. Solar can't handle that.
Yeah, not alone anyway. Yeah, I think the idea is you just build as much as you can. I think, and that's what is actually going to wind up happening. But
Agreed, because solar
yeah,
will keep improving. The panels are improving. So China's building out what enormous amounts of solar
right.
panels, way more than any other country. Although I think India is like catching up pretty quick with the amount of silver they're importing for industrial purposes. But yeah, solar panel technology will improve. The modular nuclear reactors, so those are like we're not there yet. So probably like
Yeah,
5 or 10 years from now, we're still at the concept stage where we're building. They're just going to start bringing online these pilot plants for the next generation ones.
and that's actually one area that I mean, not to get off subject, but that's one area to where I'm a little bit worried about from an investment standpoint is all the excitement that's gone into nuclear. It really does remind me of the green bubble, which 4 years ago, I mean, it's been deflating ever since, right? And so many companies, so much gets priced. I mean, and solar and wind have gone to become from just fringe sources to, a mainstream source over
Are you talking
that
about
period of
like
time.
Oklo? Are you talking about like the speculative nuclear
Yeah,
company like
those.
Oklo? So like that's the one that Sam Altman is
Yeah,
backing, and I think like Bill Gates has one, TerraPower. So I don't think they have any
yeah.
revenue yet. Oklo.
No, they're not likely to have any for some time. I mean, they're heavily dependent on subsidy, and maybe everything works out. But I mean, they seem to be priced right now as though they're already making money. And the same thing was true of a lot of those green companies that some of them are no longer exist, right? Many, and some of them have continued to make money, and some of them made a lot of money, and their products have really taken off, but their stocks reached such a high level back in early 2021. Really, a lot of it before Joe Biden actually entered office, and that it was all priced in and much more. And then when people started saying, "Hey, where's why isn't this immediately happening? Why is this price so high?" You saw some pretty nasty carnage in that sector. So
Well, that
yeah,
was
that's a
trillions of dollars of waste, fraud, corruption, and abuse, tens of
yeah,
billions of dollars stolen from the EPA and the Department of Energy. I mean, it's happened to in the Republican administrations in the
yeah,
past with their projects. I mean, I remember, Roger, you were here too in Northern Virginia. I remember when George W. Bush and Cheney were subsidizing with corn ethanol the farmers in Iowa. That was a dumb project too,
right.
wasteful and inefficient. That was the food supply, and they were using it for corn ethanol and then forcing it onto people's internal combustion engines, and corn ethanol ruins the gas tank faster,
Yeah,
the
there's
engine faster.
nothing like unlimited subsidy, to just bring out the greed in people and frankly bad decisions. And
It was worse than that, my friend. It was
yeah,
I call it ESG, energy spending grift. It was charity fraud. I mean, some of the stories we're hearing that like literally over $10 million from a lot of people who had no technology background or engineering background, no science background, were setting up fake climate change charities and were stealing funds. So
that's yeah, lot yeah, again, a big pool of money, and that's what's always going to result. And as an investor, I think you really have to be careful to separate separate what's actually making economic sense and the company's actually making money, in the here and now
well,
from
the
yeah,
government's not efficient. I think the main point, Roger, is
yeah,
the government's not efficient in allocating capital, especially for energy, because there's like corruption or political motivation behind it. Because, like in the case of Spain or Germany, they're saying that they have to keep investing in wind, solar, biofuels, ban oil and natural gas drilling, invest in electric vehicles. And in a lot of these cases, the companies didn't work out. But now
yeah,
you have the utility companies and the tech companies, and they're saying we have to build natural gas pipelines to our data center. We need nuclear power at the data center. So if they
yeah,
do that, that sounds more efficient than what the governments have been allocating capital and energy the last 10, 15, 20 years.
yeah. You know, again, I like companies that actually make money. Um,
Yeah, which is the opposite of what the government does, right? So,
yeah, 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 yeah.
well, maybe the politicians are the ones making money because you got hedge fund traders like Nancy Pelosi and Marjorie Taylor Greene. So, inside Congress, but that's a topic for another day. I want to thank you so much for your time today, Roger. Your wealth of information on utilities. It's actually like a surprising growth sector now because you see that capital that's coming from the tech companies for the capital expenditure. That is a record amount of capital expenditure, and they
Yep.
have to have the. This is the key point here. They have to have the infrastructure because if you build out the data center and you don't have the natural gas pipelines or you don't have the nuclear power plant nearby, you basically made a useless white elephant and wasted all your money.
Yes, indeed. And again, it's the most exciting. There's definitely been a lot's happened in the utility sector the last 40 years, but at least in terms of growth, this is a pretty impressive time. There in the 90s, people were often were talking about growth and from the information technology, and a lot of that was, it was paired with the deregulation and so on. And you saw a lot of crazy projections. But one thing that's different about this time is that I do see it in real time. I mean, I mentioned that example of Entergy at the beginning, but it's 12 to 13% annual growth of industrial demand is in and you consider the size of these systems. I mean, it's phenomenal what's happening right now. And we're always looking for things that can derail it and things that can go wrong. But right now, it just looks to me like you have, the companies that are providing, say, the picks and shovels of this AI gold rush, if you will, not really getting their due necessarily in the market. So I'm pretty excited about the group, and I it has been a good year for utilities, like you pointed out. Uh, but I think there's potentially a lot more down the road, just as there was, back in the 50s and 60s when you had that, and the last time demand really took off like it is now. So,
And the electrical utilities also used to be called like bond substitutes, so people would buy
right.
utility stocks instead of bonds. I mean, I'd much for growth purposes, safety purposes, efficiency purposes, in co-investments there with the tech companies. I'd much rather own electrical utility companies than a Japanese government bond or some of these longer duration U.S. Treasuries.
Yeah, absolutely. And I've been fighting that characterization of utility stocks, as somebody trying to sell
Well,
a
I'm a trained
service.
value investor, Roger. I'm sure I'm a trained value
Thank you.
investor as you were too. So we'd get
Yeah.
repeated ad nauseum that the utility companies are bond substitutes, right?
Yeah. Yeah.
So
So much
please
for
tell.
conventional wisdom, right?
Well, I mean, in the
Yeah.
environment we're in with inflation and government finances and all the wasted funds that are coming out, the fraud exposed with Doge, and a lot of it was involved with what ESG energy spending grift, fake climate change charities, and a lot of other garbage. It's just good to see the companies making investments and it's starting to pay off. And you've lived in the Washington D.C. metro area for a long time too. I mean, they
Yeah.
pass infrastructure bills every couple of years in Congress, and it seems the money doesn't get spent on infrastructure.
Right. 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 I much prefer, actually, if they're going to, throw money at the industry, I much prefer it to be tax credits for investment, right? Because then nothing gets, that's just money that comes off somebody's taxes for making an investment. But yeah, particularly like all these, the direct spending. I mean, yeah, the government does not historically do that very well. So that,
Well, it seems like
it's not a big
Congress passes. It
surprise.
seems like
Yeah,
Congress passes an infrastructure bill every 2 to 4 years, and
yeah,
then the infrastructure doesn't improve at all.
right. You still have those rotting bridges and so on. But
And old power lines. I mean, like here, even here in Northern Virginia with Dominion Energy and all the tech companies. I mean, we still have old power lines here. They haven't upgraded those yet either.
yeah, it's I think, again, all these things we've talked about. I mean, they're very real impediments, really, to what people are trying to do now. And it's I do think having all this money, from the private sector going into it, it is promising. But there are challenges for sure. And as investors, or even and as ratepayers, it's important to keep abreast of them. So I've really appreciated the opportunity to chat with you today about these things that often I just talk with myself about, or I talk to Elliot about, or I write about. But it's I do think it is an exciting time, and these are good things to continue to talk about.
Well, I think they're very important, and the market hasn't fully figured all this out yet. Some investors have, but if the tech companies are going to keep spending these capital expenditure budgets on data centers, announcing new projects, or upgrading the artificial intelligence software for the cost to come down, and spending on the learning language models and all these other things to train the model, you have to have if you're going to build out the data centers. I mean, if you don't have the power supply, the pipelines, all the infrastructure there, you've wasted all your money. So I think like the mainstream financial media talks about nonstop artificial intelligence, all the tech companies, Nvidia, but the electrical utilities, the infrastructure is more important because you have to put all those things in place before you can do all the fancy technology upgrades and investments.
Yeah, and they're really a lower risk way, and I think we probably touched on this too. But yeah, it's a lower risk way to really take advantage of this as well, because they're signing contracts. So these are the companies that
Well,
probably are some of the best to sign a contract with.
Well,
You know,
also, I can't. You're not a tech expert. I'm not a tech expert. I played around with ChatGPT now for a month, making economic cartoons and memes. I'm gotten pretty good at it, but I can't tell you which artificial intelligence software company is going to win this battle here. A
right,
Chinese one like DeepSeek, or some of the other ones, the American ones like OpenAI or Perplexity or Claude or some of the other ones. Maybe there's another one
right.
coming. Google's working on the video software. But I can tell you that as these companies keep investing and advancing the software, more people are going to use the software in other industries. That's going to cause more electricity usage. They're going to have to build more data centers. They're going to need more of these, either NVIDIA or another companies, maybe a Chinese company if they're in another country, GPU chips, and that's going to require even more electricity usage. So it seems to me that the electricity companies are in a good cycle here where they don't have to bet on which tech is going to win the race.
Yeah, I agree with you 100%.
Yep, they don't have to bet which GPU chip. So if NVIDIA is going to lose their market share, or someone's going to come out with a
Yeah,
better product, or which artificial intelligence software, which model, learning language model, or other type of software is going to win, they don't have to bet on that.
yeah. You don't have to bet on that. You just get no matter who wins. They're like the arms merchants in a war. I guess would be another metaphor.
Or Levi Strauss, right, selling
Yeah.
jeans to the gold miners.
Yep. Selling jeans to the gold miners, selling the picks and shovels. I mean, they make money regardless of who finds the nuggets, right? So,
Yes. Well, thank you so much for your time. Please tell my listeners more about your utility forecaster newsletter.
okay. Well, it's actually Conrad's Utility Investor, and we've been uh, publishing it, I guess, for about 12 years. It's comprehensive coverage of U.S. electric utilities, foreign-based electric utilities, power companies, also other essential services. Water is a big area that for the artificial intelligence revolution and so forth, data centers, communications companies, and I think actually communications and spectrum. I think AI will wind up as big a draw on that as it is on electricity. So there's a huge opportunity, there as well. And our hallmark, we like companies that make money. We recommend. We have three portfolios, and conservative, aggressive, and also a dividend reinvestment plan portfolio. And every issue gives you coverage of the whole universe, 170 different companies. So you can check us out at conradsutilityinvestor.com. You can also check me out on Substack. I've got a Substack column. It's called Dividends with Roger Conrad. So if you're not familiar with Substack, it's a great platform for all kinds of opinion, including investment. I write primarily about investment issues and utility issues there. So that's a free service. I do have a paid service connected with Substack, but the free service, all you have to do is just go to Substack, look up Dividends with Roger Conrad, and put in your email, and you'll get my column. Comes out every Sunday as well. So I'd be very interested. Anybody, please come and check me out.